You're tuned in to Agriculture Today, and we start our Wednesday show with some information around agricultural law. And as always, we're joined by K-State and Washburn law professor Roger McEowen. Roger, thanks for joining us today.
Oh, nice to be with you, Shelby.
Roger, today talking a little bit about taking the time to plan things ahead when it comes to agriculture and taxes and estate planning. And first, talking about the Tax Cuts and Job Acts. And first off, what is that?
Well, it's a law that was enacted right at the end of 2017 that took effect beginning for tax years that started after 2017. And it runs through 2025. So that changed the tax law dramatically in a number of areas. And of course, one of the things that many people are familiar with is that it substantially increased the federal estate tax and gift tax exemption from then $5 million and doubled it and then set it for inflation increases each year, and it's now just shy of $13 million per person to offset taxable estate at death as well as taxable gifts made during life. That will expire if Congress does nothing. That's just one of the things that will expire at the end of 2025, and that one goes back to $5 million with an inflation adjustment. It'll probably be about $7 million. So it'll essentially, with two more inflation adjustments, one for 2024 and one for 2025, before it reverts back to the old law, it's basically going to be cut in half. And so many people are familiar with that, many farmers and ranchers in particular, and that raises some concerns from a planning standpoint, because if that exemption collapses to essentially become $7 million, then that's going to have an impact on a lot more farms and ranches than the current law does. And that's just one aspect of what will sunset if Congress does nothing.
And a couple other aspects is talking about health insurance and mortgages.
Right, that's true. For homeowners, the current limit on the mortgage interest deduction will be removed, and so that's a good thing for a lot of people that have high-value homes or have multiple homes and are not able to fully deduct the mortgage interest. Also, the 2017 law, TCJA, removed the penalty for not getting government health insurance, the mandate under Obamacare, the penalty that was associated with that. But that'll come back starting in 2026 if Congress does nothing. Some other things that are there, people in the lower income groups will see a substantial tax increase. For starters, those rates are going to go up. Currently, those people that are paying federal tax at a 12% rate are going to see a 25% increase in their tax rate. And the standard deduction is going to be cut back in half, basically. It's going to be reduced back to where it was prior to the 2017 law, because what that law did, what TCJA did, was double the standard deduction. Now, it eliminated a lot of itemized deductions, but many people don't itemize. But it doubled the standard deduction and took a lot of lower-income people completely off the tax rolls. Well, those people are going to come back on, and then those that are, for example, in the 12% rate under TCJA, if Congress does nothing, they're going to see, as I said, a 25% tax rate increase. A couple of other things in there, Shelby. The lower limit on charitable deductions will be reinstated, and another big one, particularly for farming operations and other small businesses, is that if you're not a corporation, the 20% deduction on business income will go away. And that can be a very, very large, for example, six-figure deduction for certain farming operations, and that's going to be eliminated. So that is a major concern that's out there also.
Are there things then that producers and people should be thinking about now to maybe start planning ahead for if that doesn't get changed?
Well, the trouble with this is that we don't know what Congress is going to do or not do. So all we know as of right now is that if they do nothing, it's already baked in the cake, so to speak, as to what will happen starting in 2026, and many, many changes will occur just automatically. We've already seen how difficult it is to get a farm bill through or even have hearings on a farm bill or have any discussion with respect to a farm bill. And I'm concerned that Congress is, regardless of who's in political power at that time, in the executive branch or in the legislative branch, given the current situation in the world and economic issues, the level of the national debt, how difficult it will be to sustain and continue the existing tax scheme that we have. And I think we're probably in the most favorable tax environment that we could possibly be in, and it's only downhill from here. So with that said, what can we do? Well, it's very difficult to put a plan in when we don't know for sure what the future holds. But what we can do is be talking with our tax professionals and our planning professionals and being in touch with them to make sure that whatever plan we have in place is flexible enough to deal with any changes that might occur, deal with it in the best way that we possibly can. And that's the key, is really to kind of stay in tune, stay in touch with your professionals as to what your plan is right now, what your tax situation is right now, what your estate plan is right now, and be able to adjust as quickly as you possibly can as soon as we know for sure what Congress might or might not do.
And Roger, on the topic of talking with professionals and some of that estate planning, sometimes people choose in their will or in their trust, say, we'll let the children figure it out when it comes to farmland and other things. And why is that probably not the best option?
Well, because if you just think you're just going to let your kids figure things out after you and your spouse are gone, it's likely instead that a judge will, because there are likely to be problems amongst the children. And some people may think that, that's not a concern. My kids get along. Well, yeah, they get along while you're still around, assuming a head-knocking role. But once you're gone, all bets are off. I could tell horror stories for probably the next 4 or 5 hours with respect to that issue. And indeed, one of those situations where a judge gets involved is when the parents have left farmland in co-equal ownership to multiple kids after the last of the parents to die. And what I mean by that is that situation often leads to a partition and sale of the farmland, with the proceeds being split amongst the children, because there's commonly a child that says, yeah, this is where I grew up, this is the farm, but I really don't have an interest in it, I don't want to farm it, I'm not interested in it, I want the cash. And so they want to cash out, and they have that ability to force that as a co-owner. And that's where, if you haven't put appropriate estate planning documents in place, such as a buy-sell agreement or some other type of estate plan where you avoid co-ownership, co-equal ownership amongst the children after you and your spouse are gone, you can get into that partition and sale situation, and we just don't want to go there.
So something, probably take the time to think through and talk with your children and have a conversation about what they want and what you want.
Yeah, that's a good place to start, is make sure everybody's on the same page. Communication is the key, and then having the proper estate planning documents so that property is titled appropriately. And if there is an on-farm heir, we can get the property into the hand of the on-farm heir and use some other type of inheritance to balance out, or some other type of arrangement, such as a lease arrangement, to balance out the inheritance of the off-farm heirs. But that on-farm, off-farm heir issue is a big issue that has to be addressed.
And one other thing, among many other things in estate planning, is digital assets and thinking about those important documents.
Yeah, this is one area of estate planning, I think, that's often overlooked, and it's part of a broader issue, and that involves cataloging where all of your important documents are located and who has access to them. That is very helpful when, for example, when the first spouse dies, in particular, so that the surviving spouse knows where the necessary documents are at. Now, when you throw in digital issues, the access issue is important when it comes to the decedent's digital assets, such as accounts involving emails and online banking and credit cards and social media. The question there then is, who has access to the decedent's digital assets and information? Now, certainly the estate's executor or the trustee, the fiduciary, should have access, but it's the type of access that is the key. They need the ability to read the substance of electronic communications, and that should be clearly specified in the account owner's will or trust, and often that is overlooked. If we're looking to have access to digital assets and information and have that access granted to a third party before death, that type and extent of that access should be set forth in a power of attorney. Another thing that I think is often overlooked, because we'll run into situations, even if you've done planning, that a service provider will, such as an email account holder or a company, a digital company, will require that the fiduciary get some type of court order before they release digital information associated with the granting of access. So the key point here, Shelby, is that digital assets now are a very common piece of an estate. So we have to make sure that we've taken the necessary steps to allow the proper people to have access post-death. And that's going to save us time and expense during the estate administration process. But I fear that right now is a severely overlooked step.
Can there be tax consequences for exchanging digital assets after death?
Well, there can, because IRS has taken the position that digital assets, such as cryptocurrency, for example, are a form of property. And if it's a form of property, that has basis implications associated with it, and that has capital gain issues associated with it. And so we've got to work through those issues also. So it's not just a matter of access, and then it becomes a matter of tax issues post-death also, and that requires record keeping and documentation.
Roger, I appreciate you taking the time to join us today and share with us a few things that we should probably think about as we look forward for estate planning and taxes.
My pleasure, Shelby.
That was Kansas State University and Washburn Law Professor Roger McEowen. I'll put a link in today's show notes on agtoday.net where you can read more work from Roger.